Good day, everyone. Welcome, and thank you for joining today's edition of Teneo Insights. I'm Kevin Kajiwara in New York City. Teneo has recently issued its inaugural Global CFO and Investor Outlook Survey, a companion piece to our annual CEO survey, which is released toward the end of each year. This new survey takes the pulse of 132 global CFOs and over 200 institutional investors, representing more than $16.7 trillion of combined market cap and assets under management. Geopolitical shifts, a new and fast-moving U.S. administration, and significant trade, tariff, tax, monetary policy, and regulatory uncertainty all are conspiring to complicate the operating environment and limit visibility on the conditions to come. Here to discuss the thinking behind the CFO responses, I'm joined by two guests. Nina Trentmann is a senior editor at Bloomberg in New York, and she is the host of Bloomberg's CFO Briefing, which just turned 1, so happy birthday. Previously, Nina held a number of posts with the Wall Street Journal and the German media group Welt. She joins us today for the first time. I'm also happy to welcome back my colleague Christian Buss, a senior managing director with Teneo's Strategy and Communications Group and co-head of the Investor Relations Advisory Practice. Previously, he was Director of Investor Relations for Columbia Sportswear and was an equity research analyst with several firms on the street, most recently Credit Suisse. So welcome to you both. Thanks for joining today. And Christian, maybe I can start with you. The survey has just dropped and it's available to anybody who wants to see it on Teneo's website and was included in the invitation. But perhaps you can kind of summarize at least the key findings. What surprised you from what CFOs had to say, and what it tells you about C-suite evolution since that that CEO survey we took right around the time of the election, 6 or 7 months ago.
Yeah, absolutely. Look, I think the key takeaway is really that CFOs are taking action in response to the announcement of a different trade environment than what was expected coming into the year. There are a couple of key things that they're doing. First, and not surprisingly, they're taking steps already to alter their supply chain management. About 86% of the 300 plus people that we talked to were highlighting the need to sort of shift global supply chains. Second, we're seeing a little bit more defensiveness on the hiring and the SG&A front. Over 80% of respondents were emphasizing shifting priorities and shifting spending over the balance of the year. We're also seeing a shift in the approach to capital allocation. 81% are looking at sort of their CapEx as in play, and 67% are adjusting their plans for R&D. What this reflects, I think, is really an environment where CFOs are looking to ensure that they can protect their businesses amidst greater uncertainty. The question then becomes, what comes next? What is the sort of next 6 months of the year? What does the back half of this year look like? And there, we have a really interesting dynamic where US CFOs are much more bullish than those elsewhere. 53% are expecting improvement in the second half of the year versus only 29% of their international peers. If we look more broadly than just the CFOs, because we also talk to institutional investors in this survey, we're looking at investors that are much more optimistic about the global economy than corporate CFOs. 78% of money managers are expecting economic conditions to improve in the second half of the year. That compares to just 43% of CFOs. I think this helps explain why the S&P 500 is trading at almost 22 times forward earnings, and why we've actually seen multiple expansion over the last month and a half in an environment where earnings and estimates have come in by about 5 percentage points. What we're ultimately looking at is this big question mark of whether economic conditions are going to stabilize, whether the uncertainty that's marked the last 60 days is going to lead to more certainty and allow CFOs to really put their hand on the big green button that says, let's take steps to strengthen our position, to take advantage of a moment of disruption, or whether we're going to see more cautious behavior magnified as uncertainty persists.
So that's interesting, and that thanks for laying the groundwork there. There's a lot of data in there that I kind of want to unpack over the course of this conversation. But Nina, bringing you into the conversation here, Christian, as I say, just sort of laid out a lot of the data points that were derived from the responses of the CFOs and investors, institutional investors who took part. Talk a little bit about, you talk to a lot of CFOs for your CFO briefing and in other elements of your reporting. So how does this comport with what you're hearing? And I know Christian just sort of highlighted the difference that he's hearing from between U.S. based CFOs and a lot of the international CFOs. How does this? What are you hearing out there?
Yeah, there's certainly a lot of parallels between the survey and the reporting that I've had in recent months. I do talk to US CFOs, but also then a range of other CFOs from other countries, geographies, industries, as CFO Briefing is aiming to be a global platform for corporate finance and CFO reporting.
Mhm.
It's certainly interesting to see also how sentiment among CFOs has evolved in the past 6 months. If we're looking at data points that clearly show us that here in the US, at least that was my latest, that sentiment amongst CFOs has declined since the US elections and since President Trump came back to the White House, impacting not just spending, but also hiring, capital expenditures. And I think one big question, of course, that companies are facing is what's happening next week with the July 9th tariff deadline that we're about to hit. And then also this question is actually what we've seen in the first 6 months of the year an indication of what we're going to see for the next 3.5 years. And interestingly enough, whenever I ask CFOs this, independent of where they come from, they're saying that they're expecting more of what they saw in the past 6 months. So I've mostly heard that CFOs don't think that President Trump will, once he's done with the main items on his agenda, will maybe become a more quote normal president, and sort of less volatile in some of his decision making, that, or at least it comes across as maybe that for many CFOs. And so I think that is a big question that companies are trying to figure out, like, are the uncertainties that they've seen in the past 6 months unfold, questioning basically everything from tariffs to global trade to the role of the rule of law to the role of government agencies to the role of the US dollar, like basically putting a lot of questions, things into question that people had assumed were answered. And so I think that is one thing that I see many CFOs contending with still to this day. Interestingly enough, of course, not all of them are in this camp. Last week, for example, I heard from a German CFO that had just done a deal here in the US who were saying, well, the tariffs are going to sort themselves out one way or the other. It's not going to stop us from doing deals. So I think it's very difficult to say, given that if we're talking about global CFOs, to get a sense of where are they headed, and it's probably a little too early still, given that it's only less than 6 months that this administration has been in place. But it's certainly a period in which many companies and many CFOs are going also back to the drawing book and saying, well, so if this happens, then we'll do X. Basically, the scenario planning aspect has come up in a lot of conversations involving around tariffs and trade, just because companies still, I think, at this point, don't necessarily feel that they have the necessary clarity to make decisions. Even though, of course, there's the famous taco trade, the famous verbiage that Trump is always going to chicken out. We don't necessarily know if that's true or not. So I think that is making it very difficult for CFOs, because we know that CFOs are usually more on the cautious side of things. They aren't are involved in strategy and in big thinking, but they're also the people who are managing the finances and looking at the numbers. And so, of course, CFOs will always be in this position to try to navigate the current environment, and not take any too risky bets. Um, so I guess that's one way, I guess,
Right.
of looking at it.
Right. So I want to unpack all of that, and but before I do, Christian, maybe you could put your IR hat on here for just a moment again, though, because the environment that Nina has just sort of laid out, and which dovetails nicely with what what the survey showed. What are you hearing right now in terms of, it seems like there's this kind of divide, right? A lot of companies are giving, guidance going forward. Um, On the other hand, there have been some very prominent exceptions. Federal Express, FedEx just last week, withholding guidance essentially, or Walmart recently sort of suggesting that hey, listen, we are actually going to have to start raising prices, which sort of deviated from the narrative coming out of the White House, but. Talk about this, what's going on in the CFO's office and in IR departments more broadly as they're trying to communicate with the street about, about this set of expectations.
I mean, look, Liberation Day announcements came at a really tricky time, right at that 1Q earnings period. And a lot of companies had very short amounts of time to prepare their scenarios around what the impact was likely to be. So, very naturally, in those first 30, 45 days after the Liberation Day tariffs were announced, we saw companies fairly significantly pulling back on the level of disclosure around guidance and expectations for the rest of the year.
Yeah.
Ultimately, we're in a place now where about 25% of the S&P 500 has sort of fully fledged, fully standing fiscal 25 guidance out there. That's below historical norms of call it 40 to 50%. And if we look at quarterly guidance, usually the vast majority of the S&P 500 provides guidance. We're now below majority. We're at around sort of 40, 50% of companies providing that quarterly guidance. What we have seen more recently, though, as we've sort of moved away from that initial shock around the magnitude of tariffs, is much more fulsome expectation management and expectation setting. In the month of June, of the call it, 15 large scale companies, sort of mid cap, large cap companies that report off cycle, the ones that have a January, February year end, we've seen 12 of the 15 provide annual guidance, and 11 of those companies actually increased their guidance for the year. I think there is a little bit less uncertainty around how the cost environment will evolve. And there's certainly a little bit of a sense that the near term demand environment has not been impacted as significantly as maybe was feared. And I think there's this tension between what to expect with respect to evolving demand environment between different types of companies. It's by no means universal. The area where I think there's been the least shift in behavior has been on consumer oriented companies. What we've seen is the US consumer in particular has kept spending. And that the results that we saw in late 1Q and what we're likely to see as 2Q reporting kicks off is a relatively stable consumer in the United States. Now, the industrial economy, the more B2B economy, is one that was challenged coming into the year, and it really looks like it has remained challenged. And you mentioned FedEx. FedEx provided limited guidance for the full year, largely because how that B2B demand environment evolves is highly unpredictable. That's their most profitable business. That's the business that really drives their margin opportunity. And if there's uncertainty there, which there certainly seems like there is, it's very difficult for a company like FedEx to provide robust guidance for the full year.
Right. So, Nina, given what Christian just said, as you're speaking to CFOs, you've alluded to the complexity of the economic picture that is evolving as we look out, say, through the end of this year, second half, but also say, into the first part of next year. So let's say up to a year out. I mean, what are is there a sort of a consensus that CFOs are arriving at with regards to what they are looking at in terms of growth, what they are looking at in terms of the inflation picture, and where the Fed may have room or no room to act going forward, and therefore the interest rate and cost of capital environment that they're going to be in, but also what it's telling you about consumer confidence and the employment picture in the country. Going to Christian's point too of that the consumer facing businesses, consumer still spending, is that something that they see continuing here, or what's the economic picture you're seeing them discuss?
Yeah, I think one recent edition that we had for CFO briefing is maybe a good pointer in this. We basically spoke to CFOs about how do you detect a recession, not only in the economy, but also in your own business. And I think that's, of course, an interesting question, given that many people, when the Q1 GDP figures came in, we're looking at the huge decline and we're saying, oh, that's a bad sign. We're up for a recession potentially. And I don't want to say that we're out of the woods because it's too early to say, but I certainly hear from CFOs when I posed this question, they were saying, well, these are all the different metrics that we're looking at, but resoundingly, basically, they were saying we don't see these indications in our business yet, even though orders have in many ways declined a little bit. Some customers are more slow to place orders. People were still reasonably optimistic that the economy would keep chugging along, though at a slower pace than before. And of course, with all the risks that come with that. Plus, also people were also saying they're expecting the consumer to pull back if the signals sort of accumulate that the economy is slowing. Of course, that is contradicted right now by the fact that the stock market is at a record high, and there are of course voices that are saying, well, U.S. exceptionalism isn't dead. U.S. companies will be able to master this. I'm somewhere more in the middle because I feel maybe also it's just been not enough time to see all the effects come through, which is why I'm actually super interested to see what companies will report for the second quarter, and then
Yeah.
also what they'll report for the third and fourth quarter, because then we'll have more periods of companies operating in this environment with uncertainty, with some tariffs already in place, new tariffs taking place, and it was probably going to give us a better view than what we've seen so far this year. What I'm hearing from companies, interestingly enough, as well, is also this, that there seems to be more optimism around Europe, specifically for next year, as we're thinking about not just the huge increase in defense spending there, but also if we're thinking about factors like, for example, the increasing strength in the euro. That's certainly something that has come up in recent conversations, not just with German CFOs, but also CFOs in other countries and areas in Europe. And I'm also hearing from Chinese companies in particular that whilst the sentiment is somewhere in between, that they think over time things will improve, given that there's sort of this Chinese AI moment as well with DeepSeek, plus also a few other factors that should be pointing to the upside. It's always, of course, very difficult to make predictions, as you guys know, and as all CFOs know, which is why giving guidance is such a hard thing to do. So I guess in a few months, hopefully we'll all know more. But right now, certainly what I'm hearing from CFOs is that this sense of utter catastrophe that you got in April, where people were saying, okay, well, the world is ending if this continues like that. 2 months later, it seems as if people are a bit more at ease, even though they're also aware of the fact that there's still a lot of unknowns and President Trump is still as predictable as he was.
Yeah, I do think as a part of that, what we are starting to see is the companies that are in a strong relative position really looking to take advantage of this moment. They're looking to sort of strengthen their position. Walmart, probably the best example of this, a company that came out and said, look, this is a moment where our scaled supply chain, our automation advantages are going to work to our benefit. And what we're willing to do is make investments to strengthen our market share. I think what you will see this earnings season is more articulations from market leaders, from the companies that are in the strongest position, that they will capitalize on these moments to further differentiate themselves from their peers and their competitors.
So Christian, just on that point, when you look down the market cap scale, to companies that don't have, say, the economies of scale that Walmart has got and the availability to deploy capital to realize the efficiencies that they already have a natural advantage in, do you therefore see a real divergence in performance? Is it going to be much tougher for smaller cap or mid cap companies to be as nimble as, say, the big cap incumbents?
Yeah, I mean, scale matters in supply chains, and having negotiating leverage is certainly a significant advantage. Ultimately, though, I do think there is this recognition that we are likely to enter a greater appetite for M&A and a greater appetite for consolidation. I think the last couple of weeks have shown us an environment that is increasingly positive, increasingly attractive for an M&A environment, even though the interest rate environment is not tremendous right now.
So I wanted to follow up on something you had said earlier, Christian. You were talking about the sort of the divergence in optimism between the sort of, let's call it, the median CFO in the survey versus the institutional investors in the survey about the sort of market environment going forward. And you did talk about market or multiple expansion in the equity market and so on and so forth. So let's talk about the market picture here a little bit and just kind of give your view on it. Clearly, we have a situation where equity markets in the U.S. are touching all-time highs. However, having said that, of course, on a year-to-date basis, and especially in dollar terms, way outperformed by the rival major markets, right? Biggest, I think, widest outperformance since 1987. At the same time, the bond market now and other participants probably in the equity market as well, therefore starting to discount more that there's going to be room for the Fed to ease. So we've seen rates come down, 10 years at a 4.23 as of yesterday afternoon. And the dollar, of course, off to its worst start to the year, first 6 months in 52 years, basically since the end of the Bretton Woods system. So what's your observation right now on the market situation and what the market is saying relative to what sort of corporate practitioners that we have just been talking about are looking at?
Yeah, I mean, look, ultimately, investors don't get paid for the past. They don't get paid for the present. They get paid for accurately predicting the future and discounting that appropriately. What we're seeing very clearly is that the investment community is looking at the US as advantaged on a relative basis globally. And they're clearly sending signals that they expect at some point over the next 3 to 6 months there to be visibility into the floor. And if there's visibility into the floor of where demand might shake out, then this sort of concept of there being a big green button of investment, a big green button that allows for the acceleration of earnings momentum, that's likely to come into play. Now, it helps that earnings expectations have come in from an expectation for 15% earnings growth at the start of the year to 10% earnings growth, which kind of has the bar lowered a little bit. But ultimately, I think what's very clear from an investor standpoint is that on a relative basis, they still view the US as a great place to invest. And to be honest, right as we got the Liberation Day tariff announcement, there was a lot of capital flight out of the United States in that first 24, 48 hours. What we've seen since then is less capital flight, even with dollar weakness. And I do think that dollar weakness is something we need to watch closely. That does add risk to sort of how our more global companies in the US especially are affected.
So, Nina, you mentioned earlier that next week, on July 9th, the Liberation Day reciprocal tariffs that have went on a 90-day hold, that 90-day period expires next week. In that period, we've had one sort of quasi deal with the United Kingdom. We've had a ceasefire arranged twice between the U.S. and China. There are hints from various members of the cabinet that there are trade deals to be announced between now and next week with some of the major U.S. Trading partners. But we're going to put to the test here in pretty quick order whether this kind of sense that there's greater policy clarity is actually the correct assumption here or not. So with you talking to CFOs as we head into next week specifically, what are they how are they preparing for this situation where at the very least, it looks like where the 10% kind of across the board tariff may kind of kick in, but that you're going to have this wild variation depending on how far we get with any of these deals. How are they preparing? And also, we haven't really seen inflation show up in the in the official figures. Either suggesting that that tariffs are not yet filtering through on that, or that companies are working down inventory that was built ahead of that. But what are you sort of hearing on this front as we head into this crucial trade week?
Yeah, I certainly hear and have heard that inventories have been an important contribution as to why prices have not as increased as much as we were expecting, because companies until May, June basically had many companies at least had stockpiles of key goods that they accumulated prior to the effective date of certain tariffs. Of course, now the question is, do they actually hold on and wait to purchase more goods, or do they refill their inventories? But I think basically this working capital question is one where I think over time, yes, we'll certainly see the effect of tariffs show up, both in terms of higher inventories, but also in terms of then higher costs to refill those inventories. I think with regards to next week, there's a bit of a differentiation, of course, which companies are we talking to, because there's a ton of companies still in this world that, yes, know that tariffs exist, but that have largely a digital business, or largely one that basically is not directly impacted, for whom this is largely it's noise and it's distraction, but it's also one where they know that yes, this could impact the global economy and sentiment, and therefore it might impact us, but it doesn't have a direct impact on their businesses yet. So I think that cohort is sort of saying, okay, well, let's wait and see. And then there's these others where potentially the tariffs could have huge implications, ranging from industrial companies, those with very long supply chains in manufacturing, autos, pharmaceuticals. There's a huge range of companies that could potentially be impacted. And what I'm hearing is certainly that people are saying, well, we are prepared for different scenarios. But I also have heard so far that people are saying, well, it's not as if we're assuming that by July 9th, all the answers to all our questions will be given. And therefore, I think people are looking towards it as sort of like a temporary hurdle to overtake, and also one which might give them a sense as to, okay, well, if this conversation goes this way next week, then we might know how the next 3 or 5 or 6 months might look. But I don't think that CFOs are looking to next week as a definitive answer. As you pointed out, not really many of the, I think, up to 70 trade deals that the administration had alluded to have been formalized yet, and even the UK one is still like scant on certain details. I think the Japan one is just in the making. Also, the conversations are ongoing with the European Union. But I think, based on what I'm hearing and also what Bloomberg has reported so far, I don't think we're going to be at that stage next week where there's going to be clarity on all the many pressing questions. And so I think for many CFOs, having taken sort of different choices and options, basically keeping the variables open, has been a successful strategy so far this year, given that the range of options is huge and continues to be so. I guess we'll see how that plays out next week.
Can I ask you what you're hearing on the China front? It was notable. Teneo was represented last week, or in the last 2 weeks, at the World Economic Forum's annual China Forum, the so-called Summer Davos. And we were struck yet again by the sort of the increase in international companies' presence there, with the notable absence of American companies for the most part. But amongst international companies, there was this view: China's back, China's exciting again, and we're starting to see that, and The Economist has a big article on this just in the current issue about that China's brands are becoming more globally known, particularly in the EV space, obviously, but in other product categories as well. So, what are you hearing and differentiate between American CFOs and the international CFOs about China right now, not just in the context of trade between the U.S. and China, but the greater prospects of that economy?
Yeah, certainly. I think there is this division, as you pointed out, between U.S. companies and global companies. What I'm certainly hearing from global companies, or those based outside of the U.S., is certainly that they're seeing China as an important market. It's an economy of 1.4 trillion, with many people still on their way towards the middle class, on their way still to being able to spend more. And I think for many companies, it's not a question for them are they in China or do they operate in China? But more this, how do they organize that? Because we've seen in recent years, in the past 1 or 2 years, increasingly this conversation about basically doing a China or having a China operation and then having an operation for the rest of the world, or even having a separate US operation. And I think for global companies, of course, the politics of trade between China and the rest of the world are complicating matters, because they want to do business there and it would probably be stupid not to, but also they need to do that in a way that is palpable to their home countries, and also does acknowledge the fact that just global tensions around China, around the US have risen quite substantially. As a former reporter based in Shanghai, I certainly remember many German companies there being super optimistic about the Chinese market. Of course, many of those are now finding that, as you pointed out, these Chinese companies are now direct competitors, not just in China, but also in their home markets. We've pointed out many EV makers are selling now into Europe, are selling into other markets. And so I think the conversation of how do we as international companies view China has changed, because it's not just a market anymore, but it's actually also a strong competitor, and one that probably will still increase in terms of strength and in terms of presence, given that Chinese companies have been expanding all around the world, not necessarily always where the Western companies have gone, but going to second tier, third tier, fourth tier markets, but they're all present there. And I think, of course, that's been a bit of a reckoning for many Western firms. What I'm certainly also hearing when I'm talking to Chinese sources is that they're saying, if we import goods from outside of China, then let's make sure that the supply chain is clean, so to say, as in make sure that if we can source from Asia, that's great. If we can source from Europe, that's okay. If we have to source from the US, can we then limit that? So there's certainly an awareness that having US goods in your supply chain is a political risk, not just in China, but same way basically as it is for companies to have Chinese goods in their supply chain if they're US companies. And so I think that's a big question, of course, how this is going to play out. Like, are we really going to see this decoupling between the two countries that's been talked about, or is it going to be something in between? I don't have the answer to it, but I certainly know that it's a huge topic of conversation for companies, especially those that have significant amounts of revenue coming from China.
Yeah, I mean, we're certainly seeing more aggressive rhetoric on the decouple front out of Washington. But what happened during the sort of trade standoff between the U.S. and China put that in pretty stark display, right? I mean, the rare earths, metals, rare earths, magnets that are so necessary in Western manufacturing, clearly an issue. But similarly, semiconductor manufacturing equipment going into China. There's a mutually assured destruction element here that I think hopefully takes us away from the worst case scenarios here. Christian, I want to start looking at some of corporate strategy going forward. And Nina brought up earlier this concept of the taco concept, right? This notion, this acronym that was established by one of the Financial Times columnists, that Trump always chickens out, which could impart a little bit of moral hazard into market participants, I expect. But obviously, the lie was put to that to a certain degree by Trump's decision to go ahead and strike Iran. But the flip side of this is that what's embedded in that is that there's kind of this madman theory, right? That Trump subscribes to the madman theory, that you keep your adversaries off balance. They don't know what you're going to do. That actually prevents them from taking action. And that works in a geopolitical sense, but is much more challenging in geoeconomics, because what you do is you prevent your own economic actors, meaning your own companies, from taking long-term strategic action because they don't know what the operating environment is going to look like. So let's talk a little bit about how capital is being deployed and how CFOs are thinking about corporate strategy here in an environment, by the way, where U.S. companies are buying back, I believe, stock at a pace of about $4 billion a day currently. So you brought up M&A. There was this expectation after the election that the M&A markets were going to be kind of unleashed. We were going to see this huge flurry of activity. Things kind of slowed down in the early part of the year, but we've seen some pretty significant action since. But talk about the character of the M&A, M&A thinking in C-suites right now? Is it becoming kind of more strategic, or how would you characterize that environment?
I mean, look, it is still an expensive environment to be consummating deals. The interest rate environment has not progressed the way that I think many businesses would have hoped coming into the year. Coming into the year, there was a general consensus that we were on track for 3, maybe even 4 rate cuts. We have not really seen that play out. So the cost of capital is still fairly high. That's a natural barrier to deal flow. What we have seen as a counterbalance to that is this administration has shown itself to be, frankly, much more open to M&A and particularly consolidation. Most recently, we had the Nippon Steel acquisition of U.S. Steel approved. We had Juniper Networks acquisition by HPE approved. I think that sends a signal that, the M&A market is open. Is important is when we talk to companies and when we talk to the bankers that we have relationships with, there is still appetite. When you enter a risk-off environment, there are some very predictable behaviors, one of which is that the M&A environment shuts down fairly quickly. That's not what's happening here. We still have companies looking for deals, and actually the deal flow year over year, off of admittedly unprecedented lows, has improved somewhat.
Yeah.
I do think over the last week, we have seen the environment really open up quite a bit more. On a global basis, we had Unilever looking at Dr. Squatch. We have sort of Riskpoint acquiring Corvus. We had the rumors around the Shell BP merger that were sort of, dominating the headlines last week. And I do think we are going to see this narrative around a favorable M&A environment be one that develops over the course of the year, subject to one very simple constraint, which is that unpredictability is the enemy of good business. It is the enemy of optimism. And I think the more predictability we bring from a policy standpoint, the more we are likely to see that freeing up of capital.
Yeah, I think at the end of the day, unpredictability is a tax, right? In the sense that it sort of perverts otherwise normal behavior, right? In terms of tying up capital on inventory or preventing you from taking long-term actions. But Nina, just on this point, what are you hearing from CFOs that you're talking to on the M&A front? Because one area of opportunity, it looks like, Christian just alluded to this notion that year on year you're seeing this uptick in M&A, and a lot of that is actually concentrated on acquisitions of private companies. In other words, we have this other characteristic in the marketplace right now where there's this huge drive to unwind capital that's tied up in private companies. We're seeing this with private equity companies kind of across the board needing to find their exits, right? So is that an area of opportunistic focus and strategy right now, or what are you seeing?
It's certainly something that we've noticed and that we're seeing and hearing from companies as well. I think on the PE side, of course, there's probably still way more to come, given that many PE firms have here in the US, but also elsewhere, have held assets for 5 years and longer, which is usually the time when they really want to get out of them. And it's not necessarily, in many ways, it's still not necessarily a great environment for successful PE exits. And so I think that is probably still one where, whilst we've seen an increase in deal making, we'll see more once the conditions stabilize. I think on the corporate side of things, public companies acquiring other public companies, or also privately held companies, smaller businesses, there's of course one thing that we're seeing. You pointed it out, the dollar weakness plays a huge role, especially when it comes to non-US companies acquiring US assets. You've seen a significant decline in prices because of that for these assets, and with the dollar seemingly declining by the day, it's probably a dynamic that will continue and make U.S. companies more attractive for foreign buyers, at least those where currencies have appreciated against the dollar. What I'm also hearing from CFOs is that in industries where there's no direct exposure to tariffs, they're saying now is a good time as any. If you see a good opportunity in the market, then you shouldn't be paralyzed by the uncertainty that you're seeing in the global economy. You should just do your deal. And I think that's what's contributed to the fact that we've seen this increase in volume and in deals done in the first half of the year that many of us, including myself, didn't necessarily expect. Then also, of course, at the same time, we've seen deals that got stalled or got halted because of the uncertainty faced by Trump tariffs and the moving tariff deadlines. So I think it's certainly a bit of a mixed picture. It depends very much on where one looks at. And one other defining theme is AI that also comes up in many conversations, because not just big tech companies are looking to boost their capabilities there, but also smaller, medium-sized businesses are saying we need to have something in this space, be it if you're, for example, a tax firm, that you have AI enabled software that you can use, be it in other areas. So it's certainly something that I think has influenced deal making and has contributed to the rebound, but it's also something that we should expect to continue to drive activity. Because whilst we don't necessarily know what's going to happen with tariffs and Trump, we for sure know that AI will not go away. And for any business that wants to have a future, I think the idea is very much to use AI in some way or form.
So I want to pick up on that because, and this is kind of a pivot now away from just the general sort of policy chaos or policy environment to something more secular. And Christian, just picking up on what Nina said there, I mean, obviously, investment in AI is sort of top of mind for everybody. U.S. investment in AI companies grew to $65 billion in the first quarter. That was up 33% Q on Q alone. But from a CFO's perspective, obviously, you're talking about potentially huge outlays in areas that are all still novel. There's no guarantee all of this is going to work as planned or at a level justified by that level of investment. But there's obviously a fear of being left behind, right? And you're going to get penalized by the market for doing too little rather than doing too much in a sense. But so talk about how they are balancing the requirements for spend on, say, AI and spending smartly, not knowing what the return exactly is going to be. How are they approaching how to think about this?
I mean, look, just to put some numbers around it, tech disruption, which is largely driven by the rise of AI, is being cited as the single largest accelerant behind increased SG&A spending and capital expenditures. It's also the single largest accelerant to M&A, with, roughly speaking, 40 to 50% of companies indicating that it's factoring to their SG&A spending increases and or their capital expenditures goals. Today, I think there's a lot of talk that's very high level in general. What we're starting to enter is an environment where investors are looking for clear evidence of use cases that are driving either improved efficiency or improved customer experience, or third, improved data analytics. And I think what we're starting to see is that reckoning of who is actually going to benefit, who's actually going to see transformation of their business model. I think we actually had an interesting moment this morning where one of the big banks downgraded the advertising sector and all the largest players in the advertising sector based on the idea that sort of their ability to capture rents and capture high prices are going to be impacted by the fact that AI can do many of the tasks that traditional marketing agencies do today. Intel recently announced that they were going to be moving to an outsourced modeling for marketing, leveraging AI tools as a part of their relationship with their consulting provider. This question of what are the right use cases is, I think, going to be the big conversation between businesses in the investment community over the next 12 to 18 months. There are a few companies that have already done a good job of this that are leading in sort of demonstrating the value and the power of how one can leverage AI to make a better business. An example that I love is eBay. eBay is a company that is sort of scaled, mature e-commerce player. They've introduced a thing they call magical listings, which allows the generation of AI content to populate a listing, reducing the time to list by an order of magnitude. It streamlines the experience for consumers. It reduces friction. and it's helping drive improved engagement on their platform, which is directly translating into improved financial results, which investors are rewarding. Those types of use cases that go beyond sort of general conversations about labor savings potential are the ones that I think are going to define, outside of the AI creating companies, the companies that own the LLMs, where the investability of AI is highest.
Yeah, those are some interesting use cases. Nina, anything you would add to that in the conversations that you're having on the sort of AI anecdotal front?
Yeah, it's certainly something where we're seeing and hearing companies and CFOs talk about a lot. So one of the terms that always comes up when you ask CFOs about use of AI is efficiency. So this idea that basically artificial intelligence will make running their back offices more efficient, will help with data entry, will free people from doing manual tasks and give them more time to focus on higher value add things. I think so far that's basically the big idea and the big picture. When you then talk to CFOs, okay, well, do you have a budget, for example, that's pre-populated by AI, or do you do you hand over certain tasks in your finance organization to artificial intelligence? And most people will say to you, no, we don't, but we are running a pilot where we're basically doing a forecast the way that we've used to do it. And now we have one that is done by AI, and we're basically looking at how do they differ, what are the learnings, what are the risks. So I think it's too early to say that AI has truly taken over the finance organization in terms of running it. But I think there is this awareness that, well, if all areas of business will be influenced by AI, then of course the finance organization will be too. But then at the same time, also we have CFOs being the probably the most cautious party in the management team or the leadership of a company. And so of course I think it will take time before companies are willing to not just use AI as an assist, but something more to help them run their finances. I think in terms of deal making on AI, we've certainly seen a few companies doing deals in the space where they're buying capabilities that they previously didn't have, where they're adding to their portfolio, also using artificial intelligence. So of course, CFOs are the ones that are allocating the capital for that. But I think it's certainly fair to say that within the CFO's office, there's openness and interest to using it. But I think we're probably still 5 or 10 years out from like a widespread use of artificial intelligence in everyday financial processes. Maybe different in companies like Microsoft or others, where basically they're using their own products to run their own finances. I think there it might be a bit more advanced, but I think the everyday company is probably still in the early stages.
You know, picking up on your notion of that caution is a trait of the average CFO. I wanted to ask you both something about an interesting data point that came up in the CFO survey, and that, Nina, you actually highlighted in your CFO briefing over the weekend, which is about crypto. And that 60% of CFOs expect to hold crypto in their corporate treasury in the sort of poorly defined years ahead versus only 2% currently. But talk a little bit about what you're hearing on that very point. And it's kind of it's easy to get kind of one answer when when Bitcoin is pushing all-time highs, and it's clearly in the realm of what the White House is talking about a lot. But this can be a pretty volatile, untied to any underlying asset, vehicle. So what's the thinking here?
Yeah, it certainly was an interesting figure that in your release, which we then, because it was so interesting, included in the newsletter. What I'm certainly hearing so far is more this, that instead of the 60%, I think, that want to have crypto or see their companies holding crypto in a few years' time as part of their corporate holdings, now it's only 2%. I think what I'm hearing from CFOs is more the 2%, where we know that Tesla, Block, and a few other companies do that as part of their treasury management strategy. Of course, we also know that there's companies like Strategy that basically their entire business is just buying Bitcoin, and we'll see where that leads. But it's certainly interesting to see that in conversations with CFOs and with treasurers in particular, that there's an acknowledgement, this huge increase in value with Bitcoin and over the course of the years, but this volatility that you pointed out is certainly something also that so far, at least I'm hearing, is prohibiting many companies from holding these assets as part of their treasury holdings, just because it can create a lot of noise in your balance sheet and in your financial statements. It is something that you have to justify, not just to your board, but also to your shareholders. It's great if you're making huge amounts of money with it, but it's not so great if it goes the other way. And of course, we don't necessarily know where Bitcoin is headed. I guess the days when it fell significantly and when it was back to $5,000, those are all long gone. And probably with the backing of the U.S. government, it's probably going to go up. We don't necessarily know, but I think it's probably still going to take time for companies to get comfortable with saying, instead of investing in money market funds or in short-dated U.S. Treasuries, we'll actually allocate a certain amount of our excess cash to crypto. I think if we're looking at the data so far, interestingly enough, corporate cash holdings in money market funds have declined, and companies are preparing basically for the fact that interest rates over time will come down, and therefore we're seeing increasing allocations of corporate cash towards bonds, both government and corporate. But that's of course still a very long way to go from that to go to crypto, right? Like, I think one interview partner was pointing out to me this, that in April, when Trump made his tariff announcement and there was this huge volatility in the market, that a lot of corporates actually went and bought treasuries and then didn't buy 10 or 30-year treasuries. They bought 1 to 2 year treasuries. And this person was pointing out that this was a huge shift for CFOs, given that they're usually holding a lot of short-term cash in money market fund and other very liquid assets. And so I think then to go and say, well, we'll buy some crypto, I think some companies will do that, also for marketing and branding exercise. But I think it's probably going to take time, and I don't know if it ever will happen if like a Coca-Cola or a very traditional sort of blue chip company in America will say, oh yeah, of course, a third of our allocations goes to crypto. I don't know.
Well, to that point, I mean, Christian, what are you hearing then on just, maybe on crypto specifically, but more broadly, the point that Nina is making, how is the street looking at treasury management right now in this environment?
I mean, look, ultimately, treasury teams are responsible for maximizing returns, maximizing liquidity, and managing risk. I think it depends intensively on how the crypto markets evolve. Volatility is one of the enemies of effective treasury management. And so in as much as stable coins can demonstrate their ability to provide stability, in as much as returns can be predictably, in as much as the sort of significant swings that we've seen in the valuation of crypto assets is reduced, it becomes more attractive to treasury teams. Right now, I think it's early experimentation rather than core parts of portfolio. It will really depend on how that evolves. At the end of the day, though, risk management is probably the primary lens through which treasury teams look at things, because blowing up your balance sheet by taking on excess risk is the best way to lose your job as a treasury executive.
So I want to close out our conversation here by asking you both a question, and maybe Christian, you go for it. You started out, so we'll give Nina the last word here. But you've been painting, both of you have been painting this picture of the, at the very least, it's a very, very complicated situation, and it's not entirely clear what the operating or even the policy environment is going to look like over the next 6 months. But and Nina made the point about the relative conservatism of the CFO, just as a trait of the species, if you will. So talk about this kind of tension then between the CFO and the rest of the ELT, and specifically the CEO in this moment, and what is really kind of keeping the CFO up at night about what could get derailed, keeping that powder dry so that the CEO and the board can pursue the strategic objectives of the company. Talk a little bit about that tension and where we're landing on that. Maybe Christian, you can start, and we'll give it to Nina.
One of the things I often say is a CEO's job is to have ambition, a CFO's job is to have discipline. And I think in an environment that is as volatile as it is as uncertain as it is, that balance of power, that balance of healthy tension between C-suites and between sort of CEOs and CFOs probably tilts a little more into the discipline and into the sort of caution side of the equation. If I return to the analogy of sort of executives and investors kind of sitting in front of a big green button, hoping that somebody pushes that big green go button. I do think if we enter a more predictable environment, a less volatile environment, there is lots of appetite for investment. There's lots of appetite for risk taking. We could see that free up over time.
Nita?
I certainly would think in this current environment, probably the thing that CFOs want to happen the last and the least is to be caught off guard. And of course, in this environment where there's lots of things that are happening without people anticipating them, it's not a surprise that people have this concern. I think, of course, the question is then also, how do you manage that? And I think as a CFO these days, even in this very uncertain environment, people want and need to give the impression of being in charge, of being under control, and having all the scenarios laid out. And basically, even though they don't know what the future might bring, and often say, I don't have a crystal ball, they need to be demonstrating to investors and to Wall Street that they, even though they're hit by something that they didn't see coming, they have the answers. And I think that's interesting. If we're looking at the data, it shows us that CFO exits are actually up this year quite significantly from last year, which indicates also to us that not all CFOs are mastering this challenge right now, which probably is a tough one. It's probably the hardest time to be a CFO since the pandemic right now. But not everybody is mastering this challenge right now. And so I think that's probably the thing that CFOs are the most worried about, to be caught off guard and not seeing something coming.
Well, a fascinating conversation. I want to thank Nina Trentmann and Christian Bus for joining me today. Teneo's CFO and Institutional Investor Outlook Survey is out now. If you haven't seen it and would like to, you can go to our website at teneo.com, or you can reach out to us at Teneo Insights at teneo.com. I want to thank all of you for joining us. If you're in the United States, all the best for the 4th of July. If you're not in the United States, enjoy not having to talk to any of us for the next few days. We'll be back with another edition of Teneo Insights soon. Until then, I'm Kevin Kajiwara in New York. Have a great day.